This content is brought to you by Link2, which makes private equity investment easy. Link2 is a great platform that allows you to get equity in companies before they go public, before they do an IPO. Within their portfolio includes crypto companies, AI companies, and fintech companies. Some of the crypto companies you may recognize include Circle, Ripple, Chainalysis, Ledger, Dapper Labs, and many more. If you'd like to learn more about Link2, please visit the link in the description. Welcome back to the Thinking Crypto podcast, your home for cryptocurrency news and interviews. With me today is Diogo Monica, who's the co-founder and president of Anchorage Digital. Diogo, it's great to have you back on the show.
Thank you for having me again.
Diogo, I followed Anchorage for a long time. We spoke about 2 years ago. You guys are certainly one of the regulated institutions out there building some great things for the crypto market. There are some folks who may not have heard of Anchorage. Give us an overview of the company and some of the services that you provide.
Yeah, at its most basic level, Anchorage Digital allows institutions participate in the digital asset ecosystem. What that means is that we offer services such as custody, staking, governance, trading to allow institutions to build products in crypto or just simply invest in the market. So at the most high level, that's what we do for them. One thing that is unique about Anchorage is the fact that we were the first and are still the only federally chartered crypto bank. What that means is that we actually have a charter by the OCC, the oldest banking regulator in the United States, which is the same charter as JP Morgan Chase and BNY Mellon and all these other funds. So that's pretty unique to have a charter that allows you to do crypto at the highest level of regulatory scrutiny.
And if I'm not mistaken, that OCC charter, was that under Brian Brooks when that was passed, where you folks benefit from that?
That is exactly right. There was a set of companies that tried to go into the OCC when the OCC requested the participation and offered to actually look at charters like this. And we were the only ones that were actually able to get through. And so it's been pretty fantastic. Over 2 years, that has been pretty key for Anchorage and really has proven to be such a great decision for us, the strategy that we took and the fact that we really took the time, took the effort, which is, as you'd imagine, a very, very cumbersome and hard process to get a banking license. People don't know, but even traditional banking licenses, there's very few a year, sometimes all the way down to like one new banking license, 2 conversions. So that's the order of magnitude, low single digit. And to get a charter that actually does under charter crypto custody, staking, that's incredibly unique. And it was a big step function for crypto in terms of regulatory clarity. So we're very proud of it.
Yeah, that's awesome. I'm sure you guys are like the first of your kind, so to speak, if I'm articulating that well, because
that's right.
This asset class is still fairly young. There's still a lot of regulations that need to be ironed out, but the fact that you're not a traditional bank in a sense, a JP Morgan, has 100 years of history, but you are a crypto startup. Would that be right?
Yeah, that's right. We're, at this point, I think people would call us sort of a scale up. But yeah, 6 year in, I think we still identify with a startup mentality and with the technology background. Sometimes you say that Anchorage has a bank, but we're really a technology company that has a bank more than we're a bank that has that does technology. I think that's how I would actually describe us. And it's been pretty great to be able to push the industry forward in this way and in many ways by having technology that is superior, by adding support for so many assets, and by allowing these very large institutions, all the crypto funds, all the large hedge funds, we have sovereign wealth funds, we have pension funds, we have had very large banks, corporates. So all of these very large capitalized institutions now are regular users of Anchorage and users to participate in the space.
So tell us about the growth in your business in the context of, look, last year was really rough for the market, right? All around bear market. Look, even for the macro economy and things like that. But obviously, right, we had a lot of collapses in the crypto industry, and some of it very embarrassing, right? FTX, Celsius, and so forth. How have you guys distinguished yourselves and say, hey, we're not like these commingling funds and doing this nonsense? And how has your business grown with the different folks you mentioned?
Well, distinguishing distinguishing a company when essentially all these other companies are going bankrupt. And even the ones that are not going bankrupt are being sued by the SEC is extremely easy, because essentially what you have to do is what we set ourselves to do, which is we want to solve this problem, which is a problem of custody, staking, trading, participation in general in crypto assets for institutions. And for that, we need the best technology. And we have tens of billions of dollars on the platform, and we have proven this over 6 years. We have all of the insurance and SOC 1, SOC 2, et cetera, and the regulation at the highest level of scrutiny that allows institutions to participate. That is, really the differentiation there is proven tech with a proven regulatory clarity. I think it's fantastic. And of course, like the fact that there's all these companies going bankrupt doesn't look good on anyone, and also certainly doesn't look good on us as an industry. But what I would say is that it's been interesting for Anchorage in the sense that, yes, it's a bear market. Yes, asset prices are down. And in general, our revenue is tied to the business model of crypto. We do better when crypto is up, and we do worse when crypto is down. However, this year has actually been a pretty great year for Anchorage. Just year to date in the first quarter, we're actually able to increase our assets under custody by over 80%, almost 2xing the assets in the middle of a bear market. And we have had the launch of post-Chapella, the Ethereum upgrade, major inflows of Ethereum onto our platform. We went from under 10% of our institutions staking their Ethereum to over 40% of our institutions staking their Ethereum. And we've had a 400% increase in staked ETH. So that's pretty amazing for us as a business, as a company, and as really an institution that is here to allow traditional capital institutions to participate in the space. So we're actually very proud of it. I think in summary, if I can describe our year, we are winning a bigger portion of a smaller pie. And it is sad that the pie is smaller. We want the pie to be as big as possible and win the biggest portion of the biggest pie. However, as it stands, the pie definitely has been shrinking through the bear market, but we're winning a big portion of it. And I think the key term there is flight to safety. We are the safe harbor in times of turmoil.
That's great. And we need more trusted institutions in the crypto industry, such as yourself, and to get the market in a better place. So that's really great to hear that you're growing at such a rapid pace. And do you think that despite last year, right, what happened last year, we saw this year BlackRock and some of the largest institutions decide to throw their hat in the ring and launch crypto services, apply for Bitcoin spot ETFs. Are you seeing, kind of the same thing on your end? Maybe these institutional folks realize, hey, this technology, this asset class is here to stay. This is the future. We just have to get past what happened last year, but we're ready to move with trusted institutions such as yourself.
Yeah, it's been interesting because I think one of the major focuses, maybe I'll tell the story this way. 2 years ago, we were saying to the world, institutions aren't in crypto because the market infrastructure is not there. There's no regulated custodians. There's no regulated exchanges. There's no trusted sources of liquidity. There's no, market manipulation analysis, all of these different elements. And now we find ourselves in 2023 and 2022, and we're kind of like claiming, hey, actually, there are custodians, there are liquidity providers, there are all of these institutional participants that are legitimate. However, it turns out that there's a little small gap here, which is the regulators, actually don't just want those pieces to exist. They want those pieces to exist in the market structure to look like the traditional financial world. And so we can't have, it is very clear at this point, we can't have an exchange do retail and institutional business, be the exchange and be the custodian and be the market manipulation and integrity and be the settlements and be the clearing. It just this vertical integration that came out of need, by the way. This came out of need. We didn't have anything. There are folks out there that actually build this from scratch and had to vertically integrate every single function. There were no custodians. They had to do custody. There were no order books. They had to build the exchanges. There were no institutional solutions. There were no retail solutions. So they really had to build all these wallets, all of this infrastructure, and have done terrifically well and have done such great things for the space. But it's clear that regulators, that's not what they want. What they want is, hey, we have 300 years of banking history, or almost. And in those hundreds of years, we have learned so many things from every time that there's a major blow up. From every single crisis, from every single banking crisis, we have come up with a set of roles that work together in tandem to make sure that there's controls in place that don't allow a single institution to abscond funds or a single institution to behave erratically and actually end up causing a major loss and become an actual issue in the actual ecosystem in general. So those haven't been applied to crypto, and now they're being applied to crypto. And there's actually clamoring from the regulators to say, no, this can all be the same thing. And by the way, I'm saying this, but this clearly benefits us. And in fact, it's been our strategy from day one. Our strategy from day one has been, hey, we're going to do one thing. We are going to allow institutions, not retail, institutions only, to have a regulated, safe place to keep and participate or actively participate with their assets. And that's it. That has been the path that we've been on. And by the way, during the bull markets, it's very exciting out there. It's a lot more money in retail, and like there's all of these booms and all of these business models that you want to get into. And it's very hard to stay true to your vision. But now here we are sitting in 2023, and there's all of these bankruptcies, and there's all of these lawsuits, and there's all of these, actual violations and fines that the regulators are imposing on crypto companies for actually doing the wrong things. And here we stand with an institutional business with the highest level of scrutiny in the land, and trusted by all of the capital institutions that are further coming to Anchorage because of the path that we've been on.
Yeah, for sure. And you mentioned the regulators looking to have a certain market structure. And one of the things I thought of was the SEC custody rule that they had proposed. I'm assuming that benefits your business, but it also makes sense, right, to have a proper custodian. Tell us about how you guys are set up to meet the guidelines or the guardrails of that rule, and how are you working with like registered investment advisors and so forth?
Yeah, it's interesting. We have to do nothing for that rule. In fact, the rule further clarifies that federally chartered bank is a fantastic control location and a fantastic custodian that does fit unambiguously the definition of a qualified custodian. So in fact, you're right that it benefits us because it actually keeps or furthers doubt that trust charters may or may not actually be qualified custodians. That's actually something that is coming out of it. And in fact, it pushes pretty heavily RIAs towards not being able to do any self-custody and having to do third-party qualified custody almost exclusively, if not exclusively. So in one sense, yes, this clearly benefits Anchorage because we are the only unambiguous qualified custodian out there. So you'd expect us to be happy about it. The reality is that we want this market to have more OCC chartered banks. We don't want to be the only one. And we want the market to have the highest level of regulatory scrutiny. So it's a little bit of a hard place because even though it benefits us, we recognize that this is the right type of entity, the right type of security. And we want the bar to be very clear to everyone. And we want everybody that has the capital and the effort, willing to invest the effort to get here, to be able to get here. And so that there's more market structures. I have no illusion that a world with one custodian exists. Absolutely does not exist. The market structure is such that those things can't exist. We want actually multiple parties. We want diversification. We want multiple parties to come to the table that actually are doing things in a different manner. And that actually benefits the industry. That lack of homogeneity, right? That heterogeneity of different solutions and different technologies and different types of companies is actually very beneficial. But as we stand, yes, we are stand to benefit from that custody rule, and in general, we agree with the spirit. Even though I think for some of these funds, it might be that they find that, for example, if they're forced to use qualified custody exclusively without any carve-outs, then they might not be able to do and invest in assets that qualified custodians like Anchorage don't support. So if I don't support an asset at Anchorage, then if you're a large RIA and you want to invest in an asset, you just don't have a solution in market. And I'll remind you that there's many, many dozens, hundreds of legitimate assets and legitimate projects. And it's very hard for a custodian like us to really compete against an industry that has tens of thousands of engineers actually working on new things that they're creating, right? It's very hard to keep pace. And so it's very common that there's something that launches, especially because these RIAs are investing at the bleeding edge. It's very common that something launches before Anchorage is able to support it. And so maybe there's some leeway there that could be done without actually endangering the assets. But ultimately, what we need is more trust. What we need is more guarantees for investors and ultimately for retail that their assets are not going to be commingled, that we actually have segregation of duties, that there's actually obviously the ability of having bankruptcy remoteness, that your assets don't end up on the actual creditor estate. That's crazy, right? It's crazy that We
Yeah.
don't have that clarity. And an OCC chartered bank gives you that. That's one of the very clear things that it gives you. There is no confusion whatsoever about the fact that it is bankruptcy remote, that we have separate, we're just a custodian. So we're not an exchange. So those functions are separate, and that we always segregate customer and firm funds. So that's not an issue at all. And we're heavily audited for it.
That's great. Yeah. And I think that's certainly the standard that's needed for this market to continue to grow and for more institutional players to come in and for people to have more trust in it. Now, there was a huge partnerships that you guys formed with EDX Markets, which was the institutional crypto exchange launched earlier this year by Citadel, Fidelity, and I believe Charles Schwab. Tell us about that. How did that partnership come about, and how are you guys working together?
Yeah, it's really interesting. So it actually goes perfectly into our conversation around market structure. The market structure of crypto, you can look at it in many ways, but in a big way, it's broken, right? Right now, people have to pre-fund on exchanges to be able to trade on them, and the exchanges aren't really part of a single, settlement layer, or they don't have the ability. Institutions don't have the ability of actually having this this ability of having their assets trade on multiple exchanges. So that's actually one big problem. So eliminating the need to pre-fund accounts actually without the assets being on an exchange is something that is extremely important. So this is one of the market structure issues that we've had in crypto for a long time. The other issue, of course, is a commingling issue. So there's no way for when you put assets on the exchange to not have these commingled. That's how the exchanges traditionally work. And obviously, we talked about the bankruptcy remoteness. And so with EDX, what we're actually launching is a partnership that is awesome in the sense that they recognize that the traditional market structure is likely to be what the regulators want to see as the end state for this space. And so what they do is they do non-custodial exchange. They are the exchange, but they don't actually do custody of the assets. And in this partnership, Anchorage is the custodian of the assets. And you can have your private accounts and your segregated accounts at Anchorage participating on the exchange. And now effectively doing net settlement, which allows you to actually have further liquidity and have capital efficiency when you're actually trading on this exchange. So what is happening is, the best description is an exchange that is non-custodial, like traditional exchanges, backed by some of the most recognized institutions that participate in the traditional financial markets, using an OCC chartered bank for custody. So it's effectively a solve that looks very similar to traditional financial industry, with all the reputation and all the bells and whistles that institutions are looking for. And that's why it's so exciting, because it solves a lot of these issues with the pre-funding of the exchange accounts. So the actual capital efficiency issues, it solves a lot of the issues with bankruptcy remoteness, commingling, et cetera, that institutions can opt in to have accounts at Anchorage and settle directly to those. And that's part of the reason why it's so exciting. And remember that we're in a bear market, and yet these infrastructure news keep coming out, and these ETF news keep coming out, and all of these, there's this incessant drumbeat of things coming out that institutions are actually actively working on. So I've been saying that from inside, we see this. Of course, it's hard because institutions work on projects for like 18 months to like 24 months, maybe even 36 months. So we see the beginnings of these projects, and then a bear market comes along, but they don't stop. They don't stop working on these projects. They might slow down the pace. They might, instead of 5 projects, use 3 projects or do 3 projects. But these things are still being worked on. And now we're seeing them come out, something that I've been saying for a long time, that these things have been coming out at a steady pace for a long time.
So you mentioned like spot ETFs. What are your thoughts on the race? BlackRock, and then the whole line of folks, Cathie Wood, ARK Invest, and many more. And are you custodying any assets for any of those respective applicants for the Bitcoin spot ETF?
So we can't really, our customers rely on us for our discretion, so I can't really say names. But yes, the answer is we are obviously we're perfect for custody of ETFs. As a bank, that's perfect. And in fact, one of the big issues with the applications has been actually the fact that some entities are actually participating in the ETF with many different functions, which obviously doesn't look good, and it's not good for the industry. So having Anchorage as a custodian allows them to disambiguate, for example, the exchange and the custody, which is actually very beneficial from an application. I believe to be personally beneficial for the application of the ETF. The regulators ultimately will decide what those applications actually stand to be approved. I think what's happening is actually fascinating. It is a race. Everybody knows that the first ETF out the gate is likely to get the most flows. And then in that business is effectively about aggregation of assets, and clients flock to the one that actually has the most assets. And that's it. And it's also competition on price. Whomever actually gets the perfect, getting out first with the right price point actually ends up accumulating the most assets and making this a viable business, and everybody else won't have a viable business. That's why the race. I do think that it's likely that the SEC will approve a batch of them at the same time, such that they're not actually king-making, and I think that would be a reasonable approach. But the reality is that I don't know what's going to happen. So I'm here as a spectator, equally excited. We are helping a lot of them, and we are talking to probably all of them at this point to help them make sure that they have the best possible application and the highest odds of approval.
That's exciting. And let's talk about Ethereum staking, because you mentioned there's been record inflows of Ethereum for staking. So I would love to get an understanding of the mindset of the institutional players as it relates to crypto staking. It could be Ethereum or any other token. I personally stake ETH and other tokens that are proof of stake. Are these institutions looking at this as a passive income way of earning? They hold the assets and they are staking maybe a lot of it. And, how are they approaching that? I'm curious as to their thought process.
Yeah. So the interest in Ethereum staking historically has come from crypto native players, as you'd imagine, right? But given the recent updates, specifically the Chappelle upgrade and the ability to have liquidity, so you can withdraw staked assets from Ethereum, which was, a big problem if you're an institution or a fund and you have redemption rights, or your clients have redemption rights, then what do you do if your Ethereum is locked there and you don't have liquidity for it, right? This is part of the reason why there was a very, popular, all of these staked ETH products that came out to allow you to have liquidity, like Lido, et cetera. Those became popular because of this issue that was actually creating. But the reality is that institutions weren't really comfortable, many of them, with smart contract risk, using yet another thing. They had Ethereum, and the unknowns around liquidity and taxes and even the regulatory clarity around staking was so high that they were willing to lose 4% in dilution a year to just keep the upside on Ethereum. That's fascinating, right? That you're willing to do that. And so post-Chappelle update, you had liquidity solved at the blockchain layer. And then what we saw was that one was one of the major unlocks. After that, Anchorage helped our clients understand, the tax situation. And then obviously we showed them that our charter actually has staking as one of the businesses that we can do under the OCC. And so from a regulatory clarity, there's nothing really out there that is better than that. So institutions got comfortable, and that's when they really started uptaking their stake participation. And again, it went from under 10%, probably around 5%, all the way to over 40% now. And it keeps ticking up on a weekly basis. More institutions are ticking up. And in fact, something that we've seen that's actually pretty cool. It's not just that institutions that had Ethereum on the platform are now staking that Ethereum, is that institutions are depositing Ethereum on the platform with the explicit purpose of staking. So now, in terms of as an investment, I think what you have to think through is what they're doing is they're betting in the ecosystem. And they usually buy Ethereum because they believe it's going to be the winner or one of the winners from the blockchain ecosystem in terms of like smart contract, world computer, whatever narrative you want to add to it. But they're not coming to it as, I am looking at staked ETH and the yield compared to T-bills, because obviously that comparison is pretty crappy at the moment. Risk-free almost 5, right? And definitely risk 3% or almost 4% on Ethereum. These things are not correct comparisons. So they want upside on Ethereum and they don't want dilution is effectively that. And they're coming to it. And many of them actually, surprisingly, they want to participate in governance. They want to be good stewards of the ecosystem. They want to participate in the blockchain, use these assets for the exact purpose that they were created for. And so they want to put something at stake and participate in consensus. And we help them do that. We help them do that safely from the safety of Anchorage Digital Bank, which is pretty cool.
Yeah, that's awesome. Are there other tokens that you support, other proof of stake? And you don't have to list all of them, but I'm curious, like how many tokens does Anchorage support?
Yeah, we support hundreds of tokens. Dozens and dozens of them now support staking. And so we do it. Effectively, the way that we think about this is staking is custody. you still need to look at it's still risk, right? It is not the risk of theft, but it still requires custody, safe custody for the delegation to happen. And so the reality is that they're kind of like intermingled and joined at the hip. You still care about the actual consequences if something goes wrong. There's liability there. There's the slashing components. There's lost rewards. So all of that clients want under one umbrella. So staking in custody really is an effective way of looking at it because you need the same level of security and scrutiny and regulation. And so that's part of the reason why institutions are coming to us, and they're doing it across all assets. And in fact, Ethereum, yes, there's around 3 to 4%. So in terms of anti-dilution, if you are taking a long-term bet on Ethereum, and if you think that Ethereum is going to 10x in 5 years, then yeah, sure, 3% is not going to matter to you. But if it starts being an asset, and there's many of them, they're actually 7%, 10%, 15% staking, then you are not going to take 15% or 20% dilution a year. 5 years of 20% dilution a year is a lot of dilution. And so you're definitely going to actively participate, and you're going to demand from your providers that staking is available from day one, because otherwise the cost is just too high in terms of, even if not in terms of dollar, in terms of the unit of the asset itself. And so that is something that we do for our clients across the board, and really is from anywhere from 3 to 30%, depending on the asset, which is pretty different in terms of behavior.
Wow. It's very fascinating to hear what these institutions are doing. I'm always curious about that. And recently, I believe you all relocated to Portugal, relocated to Portugal, excuse me, where Anchorage has an office. Are you, and this is along the lines of a bigger question, which markets and countries does Anchorage support and provide services to? Tell us about that and your maybe global expansion plans.
We're a global company. We have Anchorage Digital Bank, which is the OCC chartered bank. We also have Anchorage Digital Singapore, which is a regulated entity in Singapore that serves the international market. But the reality is that we can serve everyone. The same way that JP Morgan Chase is a bank that can serve all clients from all over the world, Anchorage Digital Bank is in Anchorage Digital Singapore can serve clients from all over the world, right? And so think of that as in the general. There's reasons why you'd locate. There's reasons why you'd have Anchorage Digital Singapore, because the Asia market, has a ton of affinity towards that regulator, and many of those clients don't really want to be within the jurisdiction of the United States, understandably so, because they have nothing to do with the U.S. They're a Singaporean client that has nothing to do with the U.S. Why would they actually want to be under the jurisdiction of the United States? Or there are offshore funds that are just created offshore with offshore clients and offshore LPs, and why would they be paying taxes in the U.S. or have to deal with that regime? So there's lots of reasonable reasons why people would go outside. The bank is still obviously the bread and butter of Anchorage and really the highest level of scrutiny in the land, but we serve really everyone. Portugal is interesting insofar that during the pandemic, we opened an office here. We acqui-hired a small company, and that bootstrapped what is now the second biggest office of Anchorage and soon to be our biggest office. We just found such great talent here, not just from an engineering perspective, which is people now talk about Portugal as an engineering hub, and it is true. Lots of people coming from Europe because of the weather, because of the food, because of the safety, because of the direct flights to San Francisco and New York, because of cheap wine, whatever floats your boat. Portugal likely has it, which is pretty funny. However, for us, we found talent across the board. Product design, customer support, traders for our 24/7 network, compliance folks, legal folks, really across the board. We found terrific talent, and so we started expanding here. So that's actually been pretty good. We do have an office in Porto. We also have a small office in Lisbon that we're expanding, and we're obviously reviewing local regulation like MiCA, and which is a great first step from the EU bloc to actually get a framework that is reasonable. And we see a lot of promise there, but it's not something that we're kind of like ready to jump on right now. So right now we have we have many regulators, probably like over 20 at this point, but our two main regulators are obviously the MAS over in Singapore and the OCC over in the US. And actually working with regulators in Singapore has actually been really fantastic. It's a breath of fresh air. In the US, there's so many of them, and they're state by state, and it makes it really hard to know which ones apply and have relationships with all of them. But in Singapore, there's one. There's one set of people that like aggregate the questions, that all talk to you with one voice, and that regulate all of the financial instruments. And that's actually pretty cool. So that's it's been an interesting, different experience than in the US for sure.
Oh yeah. So speaking of the US, obviously we still need clear regulations here. Congress is working on a few bills. Some have been marked up in the House and so forth. Are you optimistic that we may see some clear regulations sooner than later? Seems like things are moving ahead, but next year is an election year. And then look, the regulators have a job to do, certainly protecting investors, but they've gotten some things wrong, right? I think a lot of people recognize that, specifically with the SEC, with losing a big part of the Ripple case, Grayscale just having a victory, Coinbase is fighting back. So there's a crazy dynamic here where the industry is fighting back now against the regulators. What are your thoughts about all of that and when we may see comprehensive regulations?
I'm very hopeful that we have maybe not comprehensive regulation because that bar is very high, but further steps towards that soonish, as soon as this year, by the end of the year. And I agree with you, election year is a little bit of a curveball. And when the price action is down like this, nobody cares about crypto. I say this in the general sense. Obviously, we care deeply about it, but in just general sense, the regulators care less. There's less money involved. There's less all of these things, and so there's a lot less pressure for them to pass things. There have been some bills that have been pretty exciting, and we continue doing engagements in DC. And it's been interesting to kind of educate for almost 6 years now the regulators, and now the place that they're at is very different, and the place where DC in general is at in terms of understanding the space is also very different. But there's definitely a set of headwinds that are hard to make it hard to predict. I do think that right now we can make progress. We can continue to make progress as it stands. And partly I'm saying that because we do have an unambiguous regulatory regime. It's very clear to us what the regulatory regime is. And even if there's lack of clarity in what these assets are, which does hinder, some types of products, or, it makes it a lot harder for you to make progress on some things because you don't know exactly what they are. But ultimately, look, a bank can custody securities. So if something is a security, we can still participate. We can still custody it. We have to follow all the rules and regulations that apply to securities, which, as you know, are very different from commodities. But we can still participate in that world. And that world is still an exciting world for us. A world where security tokens are actually a big portion of crypto is very likely, or very possible at least. And so we're prepared for that world, and we're participating and investing there with partnerships with ETSs and all of these broker dealers to be able to do qualified custody for them. So I still think that it's possible to make progress here, but obviously it's a lot easier to hope for actual changes, and changes that allow us to actually leapfrog the current state. And I want those, and I'm hopeful. I've learned to temper my expectations and carry on with the law as it stands versus the law that is coming.
For sure. And you mentioned token securities, right? Custodying securities. I'm assuming you're set up to be able to handle tokenization of stocks and different assets and things like that, because many of them will be on the blockchains that you support, like, for example, Ethereum. In addition, are you able to support NFTs for institutions?
That's right. We have NFTs. We custody a lot of NFTs for lots of institutions. We also are ready for tokenized securities. There's a lot of hard parts there, usually upstream from us, on the wrapping itself, not really on the technology side, but really on the wrapping side, and how those things actually come to be securities, how those get traded candidly, and who has access to those traded securities is a big issue, because you need an exchange to trade securities. And those exchanges, the exchanges right now in crypto are relying on these ideas that they are not unregulated exchanges and that they're not trading securities. And the SEC seems to be differing to a large extent. And so that is obviously the tension here. And so there are solves on the regulated side, there's solves on the security side. We are ready for it, but there is very little demand because there's very little demand for those security tokens. There's few of them. There's few that have actually been registered with the SEC. They're actual securities, and there's very little demand from them. And since there's little demand, means that the market is sort of there, the structure is sort of there, but it remains unused to a large extent. There's real world asset tokenization that is gaining steam, lots of protocols, lots of excitement, but we have not seen yet any kind of meaningful flows or anything that really makes us say, hey, this is here today. It's coming. I believe it. I'm betting on it, but it's not here today for sure.
Yeah, it seems like a lot of that's still being built out, and folks trying to figure out how it's all going to work, but definitely down the road, I've heard like Larry Fink, BlackRock CEO, talk about tokenization is the future of finance, but it could be 5-6 years away or 10 years away. We'll just have to wait and see. So
yeah, there's no bad ideas. There's just bad timing, right? That's one of the popular quotes. I very much believe that to be the case here.
for sure. So what's on the remainder of your 2023 roadmap? Obviously, we're going to be approaching Q4. Anything you want to highlight?
Yeah, so continue investing on these exchange partnerships, number one. So market structure. We need to solve the market structure. And now we know that it's not just about the individual pieces, it's about the composition of the market structure itself. And so partnerships like EDX are pretty exciting. And there's a few more that are coming down the pipeline that we're going to be announcing at some point. So those are going to be very exciting because they are market structure heavy bets, which is pretty exciting, right? There's lots of problems to be solved. So we are trying to solve the hard problems. On the other side, what I was going to say, staking is pretty exciting because there's clear institutional interest to participate in staking in a way that there wasn't before. And so it's not just about Ethereum. Ethereum in a way is a gateway. Once they become comfortable with Ethereum and they have other assets, they become a lot more comfortable with these. And as far as we're concerned, this is like one product. We support all these networks, all for custody and staking and governance. And so it's easy for us to enable that for our clients. So to a little bit of cross sell there of like, hey, you're already staking ETH. Why don't you stake your Solana? Or why don't you stake your Aptos or whatever it is? And so that's pretty exciting in a work that we're doing there. Networks are different. It's not exactly apples to apples, but we're kind of like getting clients comfortable with that because the big pieces have already been solved, right? The taxation piece, the regulation piece, and the liquidity piece to a large extent has been solved in many of these protocols. And so those were the three big blockers. And now that they're not there, we're investing heavily on it. And then there's all these other exciting things around institutions participating in this case. We see a lot of excitement around real world assets, yes, without the demand side. So the supply side of real world assets, definitely a lot of that happening, but a lot of settlement use cases using stablecoins and dollars. And it's pretty cool. Those volumes are real. Those volumes are big. And so those use cases are actually clear cut and valuable for the world. And so that's been actually also pretty exciting. And we've been betting on those too.
What do you think about PayPal's new stablecoin that they've launched? Seems like it's going to be stablecoin wars. You got obviously USDC here in the United States, PayPal's, and then Tether, of course, outside the US market.
Yeah, let the best one win. We need more of them. But the fight really is going to be fought on yield. That's it. That's where the war is going to be fought. With 5.5%, a stable coin generating 0%, it's pretty crazy. And the issue is that there's all these regulatory, issues with yields and actually generating yield on dollars, because the moment you have a dollar that generates yield, that could look like a security very quickly. And it likely looks like a security in many of these cases. And so it just becomes very hard for you to offer that to the general population. And if you're not offering it to the general population and folks can't just simply use it like they use USDC, then that obviously doesn't have as much benefit as USDC does. So that nut is going to be a really interesting one to crack as an industry. And I do think as long as the interest rates will be high, there'll be a lot of demand there. So that's part of the reason I think why you're seeing so many stable coins. It's a great business. Circle has demonstrated that it's a great business to have dollars out there and not share the yield with anyone. Making 5+ points on dollars, sharing 0. It's fantastic. All these other fintechs are doing 50 basis points and these folks are doing 500 basis points. And so it's like, okay, fantastic. Yeah, that's a great business. So everybody should go do it.
And then I more of a macro question for you and outlook. Obviously, this year was incredible where you had a flood of institutions coming, some of the biggest names, obviously, which you're working with, Charles Schwab, Citadel, Fidelity, BlackRock, and so forth. Do you feel we've hit a tipping point of institutional adoption where there's no longer the stigma and it's no longer taboo to talk about crypto and be involved if you're an institution? And with that said, how do you see the next few years playing out? We see more folks coming in, given that you have the likes of BlackRock, Citadel, Fidelity leading the charge here.
Yeah, 100%. And we're seeing them and we're talking to them, right? This is part of we're working with them for years, and then something launches like this, and you only see the data points of the things that are announced, but we don't get to see the rest of the iceberg, right? So it's just the tip of the iceberg. I would say I would like the iceberg to be a lot larger and bottom heavy. That would be something that obviously will continue to happen. But there's a lot of stuff being worked on right now that is pretty cool on all of these, on tokenization, on stable coins, on yield generating, on all of these different ideas, on actually having registered securities that span the crypto world. Can you trade these securities? And very large players working on this. So lots of things here that are pretty cool. The ETFs, we talked about ETFs. The moment you go outside of Bitcoin, all these things stay. So lots of innovation needs to happen there. And it's a pretty critical step for these things to be successful, for people to really adopt them, because it's a lot harder. Bitcoin has been obviously is easier, and it hasn't really been done. So imagine what the difficulties are when you further compound staking. So there's lots of institutions that are coming. We see them. We're talking to them. And of course, right now, I would say primarily it is the ones that were convinced during the last bull market. And there's less companies out of nowhere that have never done crypto and hadn't decided before to actually come into crypto, that just wake up during the bear market and say, this is exactly what I'm going to do. There's not that many of them. It is mostly institutions that were either crypto curious or already had projects that are now finally launching those projects. But there's lots of them. And so that's pretty exciting.
Yeah, that's exciting. Final question here for you. We got the Bitcoin halving coming up next year. Obviously, a spot ETF could get approved this year or early next year. Do you see the 4-year cycles playing out as we've seen them historically? Not asking for a price prediction unless you want to share one, but are you seeing like
I hate making predictions. I hate making predictions because I hate being wrong, and so that's why I keep myself out of it. Generally, I don't know. I don't really follow necessarily like all the charts and all of the math behind the happenings. Our clients have very long-term horizons. What they care really is about the industry and the space. And that's who I'm surrounded by every day. And so it's also very hard for me to care about like short-term price volatility, even though it affects, we see the graphs and it affects obviously revenue, but it's hard for me to care about it when, this is not our first bear market, and it's definitely not going to be our last. And so it's for your own mental health, it becomes a lot easier for you to kind of like associate yourself with any kind of narratives around price action and just really work on the fundamentals. We're here to build infrastructure. We're here to build regulated infrastructure in our case, and we're here to allow institutions to actually participate and try things. Not all of these things will work. In fact, the majority of them will fail. The majority of these institutions will create initiatives that'll just disappear, and we won't be talking about them ever again. But that is part of the process. That's part of the creative process of actually creating something new. And there's so much here, so much blank space, so much potential, so many different things that you can actually use. We haven't really touched on a lot of these new technologies, but the impact that zero knowledge proofs really can have on lots of these new use cases, the proliferation of auto-generated content that is going to be very hard to source what the origin is, and detecting human or robot that is now flooding the internet at a pace that has never been, and that we have clear provenance solutions and identity solutions, and we've been building them for like over 10 years, and now here we are, a perfect use case for them. So there's so many exciting things happening in the world of crypto as a whole that whatever it is, I don't make predictions of what it's going to be and how is it going to affect the price, but it's going to be very interesting, and I'm going to be here for it.
Diogo, pleasure chatting with you, and I got to have you back on as future announcements are launched by you and the team. Really excited to hear those, but thank you for joining me.
Of course, we'll do it every 2 years, and we'll kind of like compare the gaps at a regular interval. Thank you for the invite.